Welcome back. You're still tuned into Trading Hour on CNBC TV18. The market is now seeing a cut of 125 points. So we have seen a little bit of a bounce from the lows. And it is really the mid-cap index which is, helping today. So that one is currently absolutely at the flat line, but it has moved into the green a little bit. So that's what's going on with the market. But let's invite our guest for the show. We have Jigar Mistry, co-founder at Buoyant Capital, who joins us now to discuss the markets. Jigar, good morning, and thanks a lot for joining us. The first question I want to ask you is on this entire decoupling situation that we've been talking about for so long. If you take a look at our markets versus what's going on in the rest of the world, of course, the S&P 500 is down 15%. You have all of the Asian markets, which, are seeing cuts between 20 to 30%. And in that context, our markets are actually seeing a gain of 5%. So what do you think has really led to this? What explains this kind of decoupling? And do you see this as something which is likely to play out for a while longer?
Good morning, Pavitra. Thank you, as always, for inviting me on your show. Very interesting, you talk about this whole decoupling story, and if you break down the numbers, it's very, very it might look nonchalant to the extent that how could we have missed this point, right? So if you look at, say, S&P 500, for example, 27.5% of weightage is from, technology, 14% is from healthcare. Now, those two sectors, together, account for less than 18% for us in, say, NSE, whereas the largest part is contributed by financials, right, which is almost 37%. So when you look at, say, the tech component of the US market, or let's use NASDAQ as a proxy, that's down 30% from highs, whereas, banking and financials for us is up at all-time high levels. So if you just sort of account for this of the numbers that you are showing on the screen, which is a 20% outperformance, the 10% outperformance could very well be ascribed to just the sector composition, right? And the balance 10%, I would say, is relating to the re-rating that, one is seeing. You can attribute it to a better economy. You can attribute it to flows, whatever number of, things that you want to attribute it to. But I think the way it has panned out so far, where do we see it going forward? I think the base case scenario is that, we are not really out of the woods as far as the tech is concerned. A large part of this is a long duration play. And to us, we don't think the Fed is going to pivot in a hurry. So you will likely see, say, target rates at around 5% and it's staying there for a major part of the first half, at least of the next calendar, which means that this long duration assets, especially this loss-making companies, are unlikely to sort of, turn around in a hurry, in which case S&P could see continued pressure on account of its largest exposure, which is IT. On the other hand, for India, financials is as strong in a position as we can imagine. Typically, a rising interest rate would mean that, your NPA cycle starts firming up as well. But if you look at the last 5 or 6 years, a large part of incremental lending has been to, retail. And retail doesn't really form an NPA in a group, right? You have seen more of those corporate slippages happen. So I think this could continue for a bit. The amount of re-rating that has happened, one needs to sort of be cautious on that account, because historically, when your FD rates start hitting 8-9%, and your equity markets are reporting negative numbers, the retail flow into new, schemes of mutual funds tends to slow down. So part of that 10% outperformance, which is the real, not really relating to the segregation of index per se, that we could give up. But I think the outperformance, just given the structure of the index, could well continue over the next year or so as well.
Jigar, very interesting. This whole, India's outperformance is partly due to the way the indices are composed. But just to talk about the earnings picture from here on. Now, Q2 numbers look good also because of the financial space, right? I think I saw some analysis where the profits for Nifty in Q2 were up about 9% on a year-on-year basis. But if you exclude the financial component, the profits would have been down 3% on a year-on-year basis. Keeping that in mind, how do you expect earnings picture to be from here on?
Good morning, Rima. Yes, I think that's exactly right. So if we look at just pre-exceptional PBTs, I think these positive surprises were fewer than the negative ones. So banking clearly was one that was shining. If I'm just going through the sheet, industrials was one where we saw a beat. Healthcare was other where we saw a small beat. But it was predominantly driven by financials and industrials, which grew almost 50 and 28% respectively. Now, if you sort of look at how the earnings have changed, I think a few brokerages have released their report stating that they are cutting the next year earnings by about 3 or 4%, although boosting up the next calendar year earning. But the far out earnings, we have known to be very, very hunky dory until the actual numbers show up. So I think if the near term earning estimate is sort of slowing down, then one needs to be cautious. However, if you look at the sort of external situation of India, at the margin, that's looking very, very positive. So obviously, if you look at the current account, your crude oil prices have corrected dramatically. Secondly, over the weekend, the government sort of lifted the export duty on steel. And if this is any sort of leading indicator, then you could see a similar situation play out with a lot of other players as well. So especially the domestic refiners, and the potential of gas does not really flow through. So my sense is that if the external situation picks up, then the real sort of bridge joining the Western economies to the Indian economy is the central bank bridge, and that you are decoupling to a reasonable extent. So I would tend to agree. Earnings growth looks reasonably okay. The cuts have not been very sharp, and it has been driven by financials. But that doesn't seem like it's changing in a hurry now.
Since we're talking about earnings, I wanted, Jigar, your view on the IT sector, because, if you look at the data, right, the data that we have in terms of FI inflows into the IT sector is from 16th October to 31st October. And there's been a decent amount of flows. $300 million have come into the IT sector. And if you look at valuations as well, they are still a little bit lower than the 5-year average for some of these companies. I mean, Wipro, for example, is still trading lower than its 5-year average valuations. Do you think it's a good time to be buying IT stocks or investing in the IT companies? And do you think this sector has bottomed out? I mean, that seems to be, the moot point.
Yeah, good morning, Sonia. So yeah, I think if you trace it back to pre-COVID levels, it's very surprising because India does not really have tech, right? We have IT services. A tech, in our sort of opinion, is something like a Zoom that can grow revenues by 5 times in any given year. And therefore, they deserve valuations, that sort of reflect the fact that this could really be a hyper growth stock. For companies that are in India, like if they've announced a 16% CC growth, then going to 18 is a big challenge. And if that happens, the stock market just cheers like there is no tomorrow. In that scenario, the Indian IT stock should not have got re-rated with the NASDAQ. And it should not really have fallen with NASDAQ because they are two separate businesses. The one that we have is very stable. And therefore, when we go back and compare, a 5-year average with current valuation, it is a bit of a misnomer because it includes those 2.5 years of extremely elevated or depressed sort of numbers. Having said that, I think, this quarter from the commentary that we heard, it seems to be the scenario that those double-digit CC growth years are behind us. Most of us would now look at a single-digit number. And that needs to be sort of correlated to 2 things. One, the valuation, yes, are lower than the 5-year average. But also, if we are in for another onslaught on NASDAQ, which is what we believe is going to happen over the course of next 6 months, then, we will get time to accumulate these names, right? We have not really had any position in these large 4 tech names over the last year or so, but we have started accumulating HCL Tech that now forms part of our top 10 holdings, or top 5 holdings rather. And I think in the next 6 months, it could be a reasonable time to build up positions on these names.
All right. Okay. Thank you very much, Jigar, for joining in. Need to get into a break. On the other side, we'll be joined by the management of RailTel Corporation of India to talk about their Q2 numbers and the way forward. Stay tuned.